Hi guys, I've been asked to do a video on the Home Builders Scheme announced by the federal government recently, which provides $700 million of free money for home owners who are looking to complete renovations or build new homes over the next 6 months. In this video, I'm going to motor through all the eligibility criteria because there's already a million articles out there telling you guys what you need to do in order to be eligible. What I thought was more important is to go through other government money that you can stack with a grant to maximize the bang for your buck. Also, practical, smart financial decisions which you can make with the grant, as well as the mistakes or bad financial decisions that you can make in order to avoid them. So let's make sure we get every last cent of free money to afford that smashed avocado and get straight into it. This is an important disclaimer. Everything covered in this video is not any form of tax or financial advice, and you need to do your own research. Please ensure that you go to the full disclaimer which has been linked in the video description, as once you go past this point in the video, you agree to be bound by the terms and conditions of this disclaimer. There is no hiding the fact that construction activity in Australia was significantly declining even before COVID hit. In fact, some industry commentators were suggesting declines of over 23%. The thing with the construction industry is that it makes up about 6.5% of Australia's GDP. Now, this does not sound like much, but once you take out government spending from the equation, this equates to around 15% of total private spending in the Australian economy. The other thing with the construction industry is that it is the third largest employer in Australia. There is a lot of hate online for a whole range of forums as to why the construction industry in Australia gets stimulated. But ultimately, the reason being is that the construction industry is a great tax base for the government. For two reasons. Firstly, all of the income is derived in Australia, so it is taxed in Australia. Secondly, because it's labour intensive, a lot of the contractors' wages or income also is taxed, and ultimately stamp duties and other taxes flow on from it. So for every stimulus dollar that the government puts into the construction industry, they receive a proportion of that back in the form of tax revenue. So now we kind of know why we're getting this free money. What actually is it? Well, effectively, it is a $25,000 non-repayable grant for any homeowner who's looking to renovate or build a property, meaning we get the money and never have to pay it back. For tax purposes, it is similar to the first homeowners grant, meaning it doesn't form any part of our taxable income. But if the property moves from a home into an investment property, some tax may be payable on the capital base of the capital gain. Getting onto the overall eligibility criteria, first things first is it is an Australia-wide grant. The second thing is you need to sign a contract between the 4th of June and the 31st of December 2020. The final thing is that construction needs to commence within 3 months of the contract date. Now, remembering that if you're signing an off-the-plan contract or a contract with a builder, you would want to make the contract subject to the construction commencing within 3 months so that they don't bind you into a contract and then you miss the eligibility of the grant and then you still have to purchase that property. Moving along to the eligibility of a person, firstly you need to be a natural person, so trusts and companies are excluded. You need to be over 18 years old and you need to be an Australian citizen, meaning that permanent residents, New Zealand citizens or people on permanent visas do not qualify for the scheme. There is an income test on it. If you're an individual, your FY 18-19 income needs to be under $125,000, and if you're a couple, your FY 18-19 income needs to be under $200,000. This is gross income, meaning that interest, dividends, rental income, and all income effectively that you earn needs to be included in this dollar value, not just simply your wages. Finally, the income test does make mention of or later, meaning that if you sign a contract after the 1st of July, they may assess your income based on the FY 19-20 income. So if you are borderline and your income is going up, I would encourage you to speak to your state office's revenue centre to confirm if you would still qualify under 18-19 or if they're going to use your later income. The eligibility for building new is quite simple. Firstly, it needs to be a building for your own home that you're going to live in. The second thing is that the total package needs to be under $750,000, meaning the land plus the building needs to total less than $750,000. There is also a common misconception out there in the forums that I've been reading that you need to be a first home owner. This is not the case. Anyone who's looking to build a house does qualify for this scheme. The eligibility on the renovations is a little bit murkier. The budget set for the renovations has has to be between $150,000 and $750,000. Now, these have to be substantial renovations. If you go on the ATO website, substantial renovations are basically structural in nature, meaning that cosmetic-only renovations don't apply. Remembering, I have actually got the definition from the ATO website, and this is a federal government scheme. They haven't clarified what the federal scheme defines as substantial renovations, and this may differ from the ATO guidance. The guidance document of the Home Builder Scheme also does make mention of the type of renovations needing to be for accessibility, for safety, or for livability of the occupants. The other thing which the guidance document does state is that the renovations can't be for things outside of the dwelling, such as tennis courts, pools, garages, anything that is an external structure not affixed to the property. I also don't entirely understand the cap on the renovations. I think it is a PR stunt by the federal government to suggest that people who can afford over $750,000 shouldn't get it. But remembering that, you can simply have two separate building contracts, and one would qualify under the scheme and one can be staged later. I'm not condoning or suggesting you should do that because you could get bitten on the backside. But again, I don't understand why there was a cap put on. Moving across to the eligibility of the type of dwellings. Almost all dwellings are allowed: apartments, townhouses, villas, homes. But for practical reasons, these might not be ideal, and let me explain why. With off-the-plan apartment sales, the construction can't already have commenced. So if you sign an unconditional off-the-plan sale contract and the builder then starts the construction within 3 months of you signing that contract, you may qualify under the scheme. But for practical reasons, this is pretty hard. The other dwelling type which has not been mentioned but is becoming more common in Australia is granny flats. Now, under other ATO rulings, a granny flat is not considered a separate asset because there aren't two titles on the property. So again, we don't know if granny flats would qualify under the scheme, and I will explain this in more detail in the debate later. Also, it is worth mentioning that to qualify under the scheme for building new and renovating, that you cannot be an owner builder, and building contracts need to be independent and at arm's length based on commercial terms, which can get quite tricky if you are trying to build for a family member. And the final eligibility criteria, which is the most important of all, is that you need to subscribe to this channel, because if by law the ATO requires me to provide them the subscriber list, I will have to send them my subscriber list. Moving across to when the grant is paid and how the grant is paid. One question's easy, one question is hard. The easy one is that the grant will be paid through your offices of state revenue, and it will be a similar process to applying for a first home owner's grant. The complicated one is when the grant will be paid. There has been no determination yet as to when or how the grant will be paid. Ultimately, we don't know if it's going to be at contract, if it's going to be at slab down, or if it's going to be at completion. So this is an important thing to consider if you are planning to use the grant as part of your cash deposit. You may need to carry it for a period of time. I'm also just going to read out what documents you need to apply. You need photo ID, you need a building contract, you need the building registration number, you need your 1819 tax return or later, and you need council approvals, building contracts, occupant certificates, and evidence of land value. So they will assess all these things and make sure you qualify. Moving on to, can you stack this grant with the other government grants? Now, if you like free government money, you need to like this video and subscribe to this channel, because the answer is yes, you can get the first homeowners grant and the home builders grant and any other possible grants that might be available. So let's dig into that. The federal government's first homeowner saver scheme will apply with this grant, but there is something which I would like to mention that hasn't been covered in the home builder. On the ATO website, it does mention that the income received from the first homeowner saver scheme does form part of your income. Now, because there's an income assessment on the home builder scheme, will that income impact your eligibility criteria? There is some debate, because it does state that the income that you receive from the first homeowner scheme shouldn't be used on other government schemes to be assessed. But again, it hasn't been clarified, so it is worthwhile mentioning. The first homeowners grants across all the states do apply, and I've created a quick table and included that in the description of this video so that you can reference it. So I'm going to go through this table. In New South Wales, Victoria and NT, the first homeowners grant is $10,000. In Queensland and SA, the grant is $15,000. And in Tasmania, the grant is $20,000. In Western Australia, the first homeowners grant is just $10,000, but I wanted to mention something. The state government has actually released an initiative recently in the last couple of days which allows an additional $20,000 to anyone who's looking to build a home, meaning that you'll get the stamp duty rebate, the first homeowners grant of $10,000, the $20,000 from the Western Australian state government, and the $25,000 home builder scheme. So you could be up for close to $65,000 in government money if you are a first home buyer. If you're not a first home buyer, you still get the home builder scheme, but you will also get $20,000 from the West Australian state government. So you'll get $45,000 of free government money. The real kicker to all this money in Western Australia for first home buyers is when you apply that $65,000 over a 30-year loan at 3% interest on P&I. That initial $65,000 is an equivalent of $107,000 in interest savings, remembering that most first home buyers will be buying homes $300,000 to $400,000, meaning that the actual dollar saving is massive. There are a couple of things outside the grant that you need to consider, and the first thing is financing. Number one, the $25,000 grant, similar to the first homeowners grant, won't be considered as genuine savings by banks, meaning that you will still need to have other savings to demonstrate you have the ability to get a loan. The second thing is, if you were thinking of using a 95% loan and the deposit in order to purchase a property no money down, this is not the case. Remembering that most properties need a buffer when you buy them, and the actual deposit which you might need to save is closer to 8% of the property's value. So the $25,000 will make a chunk of it, but again, we don't know when it's going to be paid, so you'll ultimately probably have to come up with a savings and then get rebated back from the government. The third thing is if you are looking to buy and trade up and you are no longer eligible for the first homeowners grant, you probably need to be considering 10% of the property's value in terms of a deposit, even if you apply for this grant, because you're going to have to pay stamp duty, you're going to have to pay LMI, and this grant will help reduce that, but ultimately there will be some costs that you need to bear. The fourth thing is if you're looking at renovating a property, you need to find that $150,000 from somewhere, and cashing out can be a little bit tricky. So make sure that you speak to your bank or your broker about all of these scenarios to ensure that you have the ability to get the money. As a little side tip from all this stuff is make sure you also check that all the people that are providing you quotes for building works are registered builders, because it is an eligibility criteria, and I guarantee that with all this extra free government money, there are going to be some not so savoury characters going around offering building works. So let's talk about who should not use the grant. The first group of people is first home buyers who haven't done their budgets and don't know if they can afford to hold the property long term. Almost always when you build in new land estates, you are in negative equity. The agent's fees alone to sell the property is probably close to $10,000, meaning that if you're forced to sell in a couple of years because you can't afford it, you're going to be eating up all this free government money and you're not going to qualify for the first homeowners grant again. The second group of people is don't just trade up to trade up, meaning that if you're planning to build a bigger house just because there's free government money, that doesn't make sense, because if you have to buy a block of land at $300,000 for the second time, the stamp duty alone is about $15,000, and the agent's fees on selling your existing property is about $15,000, meaning that you're going to be out of pocket $30,000 to get a $25,000 government grant. If you're actually trading up to trade up because you need a bigger home, it makes sense, but otherwise it doesn't. The third type of people that doesn't make sense is the cosmetic reno dodgers. And what I mean by that is if you think you can do a new kitchen for 40 grand and a couple of bathrooms for 30 or 40 grand, repaint the house for $10,000, $15,000, redo the flooring, $20,000, $30,000, quickly it adds up to $150,000. Well, they are assessing the eligibility, and I would be concerned of having to pay back that $25,000 if you've committed to all of these renovations. The fourth type of people is the renovators to renovate and get debt. If you look at a 30-year loan at 3%, this $150,000 renovation is actually $245,000 in total costs. So effectively, it's about $100,000 of interest over the term of the loan, meaning you save 25 grand of government money up now, but you end up paying $100,000 of interest. That doesn't make sense. The fifth type of person which doesn't make sense is the renovate to flip, thinking that you can put some structural changes to your house and sell it for an additional price. This is not the case, because almost all structural renovations don't dollar for dollar return the investment. If you're spending $150,000 and only getting 50 cents in the dollar, you're going to be getting $75,000 back on the structural renovations and improvements of the home, but you're only going to be getting $25,000 of government money. Again, don't think you can put some structural renovations into your house and flip it for a higher price. The next type of person is people who are drawing on LVRs over 90% in order to fund the renovations. What I've pulled up is a quick table to show you the amount of lender's mortgage insurance you're paying at different price points. And ultimately, if you're paying lender's mortgage insurance just to get the grant, if you're paying more than $25,000 in lender's mortgage insurance, you are net in a worse position than you are today. And the final group is renovations over $350,000. I've put up a quick table as to my calculations, but anything over $350,000, the actual grant only makes up about 7% rebate on the cost of renovations. Now, there's actually a lot of other factors such as the building process and tendering process and negotiation and materials, which will make a much bigger impact than 6 or 7% on the contract price. So moving right along to what does a $150,000 renovation get you? Well, there's a great little guide on Archicentre, and I'm going to pull up the website now and also link in the description the website address. The first type of renovation you would get would be an additional living area, an additional bedroom and an ensuite, and some minor cosmetic renovations, which does comply because you are doing some structural elements. The second type of renovation, which would be one additional master bedroom, one ensuite, possibly a cosmetic kitchen upgrade, the other bathroom cosmetic upgrade, and also upgrades throughout the house. Again, that would qualify because you are doing some structural elements. But remember, if you're going from a 3-bedroom, 1-bathroom house to a 4-bedroom, 2-bathroom house, you're probably going to want an additional living area. So what are your financially savvy options when considering using the grant for a renovation? The first people I think that will get the biggest bang for your buck is when you're converting a 3-bedroom, 1-bathroom house into a 4-bedroom, 2-bathroom home. There's actually a great tool on realestate.com. What this allows you to do is look at the difference in median price in any given suburb of a 3-bedroom home and a 4-bedroom home. Remembering that the data is a little bit skewed because it's common to have a 3-bedroom, 1-bathroom layout, whereas it's uncommon to have a 4-bedroom, 1-bathroom layout. So when you're comparing like for like 3x2 to 4x2, the difference is not going to be as large. Not only do you increase the value of your home when you turn it from a 3-bedroom, 1-bathroom home, but ultimately if it turns into a rental property down the track, it's likely that you will get more rent for it, and the website does also show the potential additional rent which you will gain. The second type of renovation which I think will get some extra bang for your buck is granny flats, and there are some debate around it. In this AFR article, they did mention that granny flats were particularly excluded, but it talked about being a detached dwelling. But the funny thing is the federal government fact sheet, which this AFR would have sourced their information from, doesn't mention granny flats. So it may be possible, provided the granny flat is attached to the additional dwelling, you can add an additional living area, additional bathroom, bedroom and ensuite for around $150,000 and still potentially qualify for the grant. Now, I'm not suggesting do anything dodgy, and the intent shouldn't be to rent it out, but say for example you had an aging family member that's finding it very hard to move around your property and you want to purpose build a granny flat that makes it easy for them to live, such as your grandparents. Again, coming back to the initial criteria of the grant being that it's for accessibility, it is more than likely that you may qualify under the grant. Ultimately, if you move out of the property later and it turns into an investment property, a property with a granny flat rented separately would potentially achieve more rent. On the flip side of this, let's talk about the financially bad things you can do when considering renovating and getting the grant. Number one has to be using LMI in order to be able to get out the money. Ultimately, if you're paying LMI, you're effectively getting the grant and giving it to the bank, and it does not give you any net benefit. The second thing is if you're overcapitalizing. If you're going from a 3x1 house into a 4x2 house, it might make sense. But say for example, you've already got a 4-bedroom house and you want to go to 5 bedrooms or 6 bedrooms, this is considered overcapitalizing, and this is probably not going to get you your return back on the dollars you've spent. I'd also like to consider fixtures and fittings in an area. If you're putting gold-plated taps in an average suburb, it's more than likely never going to get the return. And finally, when value is considered a rate per square metre on the entire building area of a home, generally the rate per square metre diminishes the larger the home gets. So as you're growing your house out bigger, the return you're getting is proportionally lower. And finally, the worst type of renovation in terms of a cost per square metre would be going from single story to double story, so almost always consider renovations on the same level. So what are your financially savvy options if you are looking at building? The first things first is if you're planning to build and use LMI, Do not increase your budget, just simply use the grant in order to reduce your LVR and pay down your loan balance. On a $400,000 purchase price, paying LMI at 95% and getting the $25,000 to reduce your loan balance, the equivalent on a 30-year P&I loan at 3% interest is about $50,000 of savings, 25 of the grant and 25 of interest, which is massive. If you tell me, look, Ken, I do want to increase my budget, I do want to spend more, I don't really care about saving money, what's your other option? Well, what I would suggest you do is speak to your bank or broker about that $25,000 and see if it increases your borrowing capacity. By increasing your borrowing capacity, if possible, go and look to a better area. And what I mean by that is don't necessarily look at all of the house and land packages. Go to an inner city area and find a better block. And the reason being is ultimately you reduce your commute time, you'll potentially have better investment returns or growth rate on the house itself. And finally, yeah, we'll have a better quality of life living closer to the city, provided that's where you want to live. It is arguable that if you buy in a better area, potentially the growth that you will get will offset the interest and LMI savings on the balance of the loan. But ultimately, it is a roulette wheel. You don't know if the future performance of an area that you're looking to buy in or perceive as better is actually going to have better growth rates. And this gets me on to the financially bad things to consider when building new and using the grant. First things first is what I mentioned before, and that is using the grant to spec up your home. There is going to be immense pressure from builders to get you to spec up the quality of your home on cosmetic things such as fixtures and fittings and appliances. And that is because the building margins on those things are massive. This is the financially worst thing that you could potentially be doing with that $25,000 grant. Second thing is not using the grant to pay down LMI. LMI is not there to protect you. It's in the case of a default, it protects the bank. Ultimately, if you are paying LMI and then paying interest on getting an LMI, that is crazy when you've got $25,000 of free money there from the government. And I'm finally going to conclude with some tips and opinions on the grant. What about permanent residents? Well, permanent residents don't qualify, but say you have a spouse which is an Australian citizen. Rather than going in and purchasing property with both of you on the title, it is better to consider purchasing the property on the title with the Australian citizen, because then they would meet the eligibility criteria. But how do you protect yourself? Well, that's when I would go to a lawyer, speak to them about a binding financial agreement, speak to them about caveat, speak to them about a loan deed, speak to them about all the other options that potentially you can use in order to protect yourself. The second type of people that is oddly affected is someone who has a big block who is always planning to subdivide the lot. If you're planning to subdivide the lot, it's probably not going to happen in time for this grant scheme to end. But if you would apply to council under a built strata scheme with a planning approval and then go to build the house, you may still qualify under the home builder scheme. I'd argue that the current fact sheet doesn't say that the subdivision or titles have to be complete. It just simply states that the building contract has to be signed, meaning that if you're planning to subdivide a property and you can't yet, what you could potentially do is get all the plans done, get the building contract all signed, and then once you qualify for the scheme and you are midway through the construction, you can then apply to subdivide the property. Remembering that bank funding will need to be taken into account because you won't have two subdivided lots, so you'll have to fund the construction from somewhere. The third type of people which this scheme could really benefit is retirees who are always planning to subdivide their property and downsize. Now ultimately you can't use the scheme with the intent of being a developer because that is not building the home. What you could do is knock down your house, build a new home in the location which suits a subdivision, but keep the land as one title, and then in later years when you come to subdivide, you can effectively put up a fence, have a driveway, and sell the land at a later date. This brings me to the end of this video on the home builder scheme. What I'd like to do is get all your questions, comments, and clarifications in the comment section below so that I can answer them, or if I've missed or made a mistake in the video, I will rectify that. But most importantly, like this video and subscribe to the channel below, because I will be bringing you more content heavy videos on property and financial education. Make sure that you enjoy all the free money from the government, and until next time, thank you.